Hello students, this video clips will cover the how to calculate the stock price from the relative valuation, the multiple method. Also, we'll consider the incentive compensation round with the multiple, the venture capital investors round. We already covered these two scenarios. Previous one is multiple round financing, and it's just the one financing round with $1 million, and the exit point was the 5 years, right? Now we develop these two cases to the incentive compensation round, assuming that the use of the $200,000, the compensation, incentive compensation proceed has already been included in the projected financial statement. Okay, so the share will be distributed through a stock option plan, and I expect to generate 200,000 in exercise proceed when the options are exercised at the end of year 5. Okay, so the point is here we need to set aside certain percentage here, the 6%, right? The 6% of the shares at the exit time. So 6% of ownership will be set aside, okay, as the incentive compensation. The same process, the shares before all the financing was 2 million, right? And then new venture investors, first round, 1 million. And then the same, the second round, 1 million, 1 million. And then horizon time to exit at the first round. How long years is the vintage years? 5 years. But after the second round, they invest the 2 years. The investors' annualized rate of return, required rate of return for the first round, 50%, and 25% for the second round investor. Projected venture income, net income provided by the entrepreneur, the venture firm, is 1 million. Comparable venture value sold to, now we are using the PE ratio at the end of exit year. So we are given 2 million, right? 20 million. So the same cases, the previous scenario. And then 2 million was, right, the venture, comparable venture firms. Now, what is the PE ratio of the comparables? Right, 10 times. This 10 times will be used to get the venture value, total ventures company's value at the end of the year by just multiplying, right, the projected venture income per year. I'm sorry. And then 10 million, right? This 10 million is the venture value using the PE relative method. Now, let's break down this 10 million into, right, first round investors, second round investors, incentive compensations, and founders remaining in the form of the change in the ownerships, right? So here, how do you get it? So you guys remember, right? How to get it? Right, compounding from the investment, right? Investment today for the first round of financing is 1 million, and then it is increased by 50%. So where is 1 million? There you go. First round will be increased by, right, 50% for 5 years, right? That is the value of the first investors at the exit year, right? But we need to get the percentage of the ownership divided by, right, the venture's value using this PE ratio multiples. So we got 75% is the percentage of ownership acquired by the first round venture investors. Again, as explained during the class, we first measure the percentage, first measure the value of the firm, and then we'll find the percentage of ownership of each investors, right? And then we will get this founders remaining value. This founders remaining, the percentage of ownership will be used to get the total number of shares. So 2 million shares was existing, right? And that is not going to be changing, right? So 2 million over this founders remaining is total number of shares. That's why we need to first calculate, right, the percentage of ownership acquired by investors. Second round, they also invest 1 million, right? That it is increased by 25%. Why? Because the second round, mostly the company, the venture firm is now get successful, and then they require the lower the required rate of return. Then it is increased by 2 years investment after year 3, right? As explained the second scenarios already. And then now divided by, right, what is the venture value at the exit year? The numerator is the venture second round venture investors, the future value, right? Divided by, right, this. So we got 15%. Now, what is the other percentage of ownership to set aside for the investors' compensation? Right, the 6%, which is given. So we got 100% of total minus 75 minus 15 minus 6%. So 2.43% is the remaining, the founder's value, right? Founders the ownership. Now, how do you get this total number of shares? Now is the time to calculate the total number of shares by existing number of shares of the owner divided by the founders remaining, right? The percentage of ownership, so that we get this total number of shares at the exit year 5, right? Now let's get started from the first round. First round investors. Now how do we get this? How do we get this shares issued for the first round investors? Once we got 82, right? 82. Then how many shares should be for the first investor? There you go, 75% times, right? This. So 62 the shares must be at the first round investors owners, the number of shares owned, right? Then once they got this number, they invested, number of shares invested. How much was the investment? 1 million divided by, right, this shares issued for the new investor is, now finally we got the share price at the time when they purchased these 62 million shares from the venture firm. The stock price is now, we got 1.6 cent. You guys understood? Right. Here, what is the total number of shares just right after first round? This is 62 million given away, and then 2 million existing, right? So 64 million is the total number of shares at the time, the first round, the financing, and then they issued 62 million, and then total number of shares 64 at the stock price of 1.6 cent, right? Then what is the founder's percentage at this time? This 64 is total number of shares, right? So 2 million was existing, and then total shares is now 3.11% is founders. It's different from 2.4 because 2.4 percentage is considered, right, the second round financing, but we haven't got second round yet. Here, the first round investors percentage between the first and the second round is now very easy. One more time, 62 divided by 64 million. And then sum of these two is definitely 100%. Then what is the pre-money valuation before the first round? the stock price per share is 1.6 cent times total number of shares before first round was 2 million, right? Only the owners. So the 32,000 is the pre-money value before the first round. That's why this valuation process is applied to the early stage company, giving so many the shares away to the venture investor. Post-money valuation is this stock price times now what is the total number of shares, because we the venture firm gives this 62 million in total, so 2 million plus 64 million, right? And then we got the post-money valuation. Let's check up new investment for the first round, definitely 1 million. This 1 million just right after this the first round will be added to the value of the firm from this 32,000, right? So total the post-money valuation after the first round is 1,032,000. Now let's go to the second round. After 3 years, what happened? Now the shares issued for the new investor in the same way here. Same way, this must be 15% times total number of shares, because they will hold this 12 million shares at the end of this exit year, right? So they got this 12 million. Now, once we got this number of shares, how to calculate the stock price at the time new investor, second round investor invested? How much is the investment amount? Right, 1 million, right? 1 million divided by, right, number of shares. So they purchased this share per share price at 7.8 cent. This is now increased because, again, 25% is the discount rate at the time. The stock price, yeah, definitely increasing. And then total shares after the second round can be calculated. How? Before second round, how many shares was the total shares after first round? Right, 64. Now we add this 12 million. So we have new those shares after the second round, right? But it's still not the same as 82 million, because now you expect some additional shares issued for employees at the incentive compensation round for employees, right? The founders remaining, now how to calculate the founders remaining here. Founders remaining, how to calculate the founders remaining, right? 2 million, right? 2 million shares was the existing number of shares divided by what is now the total number of shares after second round, right? So 2.5. Now it is now the founders remaining from 3% to 2%, now diluted, right? Because new number of shares issued, right? And then first round investors percentage between first round and the second round. How to get it? Right, 62 is the first round investors, the number of shares that they have been holding, right? And then divided by new total number of shares after second round, so 80%, right? So as you can see here, 96% is diluted to 80%, right? Now second round investors percentage, now just 12 million divided by 77, so 16. So as you can see, this is sum of these three is 100%, right? Now let's calculate the pre-money value before the second round from this stock price per share times, right? How many shares? How many shares was the pre-money valuation before the second round? That's the point. Where is it? Where is it? Right, here we go. 64 million, right? So 5 million $16,000 was the pre-money valuation, right? But this after money, after post-money valuation, now the price per share times we have to apply. This is 77 million, including the shares issued for the new investor at the second round. So let's check, double check if we correctly incorrect. Very good, but still we need to go one more step for the incentive compensation round here. Now shares issued for the employees at the exit year, how to calculate? Here, we already set up, right? Set aside is 6% from the owners, right? So 6% times. Now, at the end of the exit year, so they must have 4.9 million shares, right? For the incentive compensation. Total shares after the incentive compensation round, we do not calculate the investment because again, $200,000, the stock option cash proceed is melted into these projections. So we do not calculate the stock price per share in this case. Total shares after the incentive compensation round is now, we can just add the before the incentive round, and then finally let's compare 82 here at the exit point, 82 at the exit point, right? We figured it out. Now the founders percentage after incentive round is now 2 million shares divided by, right, finally this, and the 2.4375 must be same as here 2.4375% when we start from the start point here. And then first round investors, how to get it? First round investors got this, right? Divided by, one more time, and then we got 78%. Oh, sorry. This is not the first round. There we go, 62 million shares, and then 75. And then the second round investors got this 12 million shares, so 82 million, so 15. Employee percentage. How to get the employee percentage? Now 4.9 million divided by 82. So we got exactly, right? We got exactly the same result as, yeah, this we calculated before, right? So that's how we calculate the stock price in each financing round. And then how do we start? First, we calculate the future value, right, at the exit year. And then we calculate the percentage of ownership based on the investment amount compounded by the required rate of return, right? And then we got this percentage of ownership. The point is to get the remaining percentage of ownership for the founders so that we get this total number of shares. And then we go to the stock price calculation, because we now can get the shares issued, and then we got the stock price, and then we can calculate the pre-money valuation after money valuation. We know the percentage of ownership, we know the number of shares in each round, the investors and existing number of shares and owners for the owners, and then yeah, we can also calculate the post-money valuation after the each round. Okay, so the second scenario or first scenario we already covered during the class, and then using the answer file, how you can practice is much easier, right, than the last cases. Okay, so see you in the next other video clips. You guys, bye bye.